Hi everybody, Griffin Bridgers here. This is going to serve as a free preview video of a broader series and follow-up video on how exactly various transfer tax exemptions work. Now before we get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is being provided for educational purposes only. So as we'll see before we jump in, when I say transfer tax, what I mean is gift, estate, and generation skipping transfer tax, all of which have their own unique exemptions and exceptions, some of which are unified and work together, and others of which are independent of each other. But this series will give you a broad overview of how they interact, but not necessarily an in-depth view that allows you to jump in without hands-on experience. Now, since this video is a free preview of a broader instructional video, I want to mention who the intended audience is for both the free part and the paid part. With this and all of my content, I created it for professionals who assist with wealth transfers, people like attorneys, CPAs, trust officers, financial advisors, and others. I'm not creating this for individuals needing assistance with their personal planning or who are seeking to do it themselves. So with that being said, I want to mention that the follow-up video will be reserved for paid subscribers to my newsletter on Substack, State of Estates, at the link below in the notes for this video. But again, because I'm intending this for wealth transfer professionals, I ask that you not subscribe for the paid subscription option, especially if you are also not a wealth transfer professional. So let's jump in. So when we have transfer taxes in general, what we're looking at is a couple layers of them. We have gift and estate taxes that we usually see, one applying to transfers during life and the other applying to transfers at death. And then also an additional layer that, in addition to the gift or estate tax, can impose what's known as a generation skipping transfer tax for transfers that intentionally skip living members of the generation immediately below the transferor. So we're not going to get into the exact details of that tax in this preview video, but generally I emphasize these because they're not the same as income taxes. Usually when you receive a gift or inheritance, as long as certain requirements are met, there's going to be no income taxes on that gift or inheritance, except for certain types of transfers. Instead, you have gift or estate taxes that serve as excise taxes imposed on the person making the transfer or their estate as an excise on the privilege of being able to transfer wealth during life or at death. With that being said, we generally have gift tax that happens for transfers during life and estate tax for transfers as a result of an individual's death. Then we also have a generation skipping transfer tax, which is another layer that can apply both to transfers during life or transfers at death that, as I mentioned earlier, intentionally skip living members of the generation below the transferor. Now, with that being said, there's a broad exemption to the gift and estate tax that we're going to start with. It's called the applicable exclusion amount. So every U.S. citizen or resident has, starting out at least, a basic exclusion amount, which is currently inflation adjusted $13.99 million in 2025. It's subject to a possible sunset of the tax laws at the end of 2025, but we're not going to get into that right now. There might be, in addition to that, the deceased spousal unused exclusion amount, or DSUE. That's only available to widows whose most recently deceased spouse made an election or had their estate make an election to preserve the deceased spouse's unused basic exclusion for the widow. That amount, unlike the basic exclusion amount, is not adjusted for inflation. So the applicable exclusion is made up of both of these components, but for purposes of this course, we're going to focus on the basic exclusion amount. Now, this exemption is unified, which means what is used to offset gift tax is going to reduce what's available to offset estate tax using a cumulative calculation, as we're going to see. So let's look at this a little bit further. So we have gift tax that accrues on transfers during life and estate tax on transfers as a result of death. So when we look at these combined, our gifts and estate taxes on a chronological basis are going to be offset by the applicable exclusion amount. So use of exclusion to offset gift tax during life is going to reduce the amount available to offset estate tax at death. But the way we get there isn't going to be quite that simple. It's not a simple numerical subtraction. Now, before we look at how that looks and works, we're going to first dive into the annual exclusion. This applies only for gift tax, and there's a certain ordering rule by which this applies before we start looking at the broader gift and estate tax applicable exclusion, that lifetime exemption. Now, what the annual exclusion says is that for each person who makes a gift, they get for each recipient an annual exclusion of up to $19,000. It can't be more than the amount of gifts during the year. That amount is adjusted for inflation. That inflation adjusted amount in 2025, again, is $19,000. And this exists because the IRS doesn't want to have to track every single gift made during the year. The gift tax is really designed in spirit to capture intentionally large transfers of wealth. It's not designed to capture things like wedding gifts or small amounts to help out children during the year, or holiday gifts or anything like that. So, with that being said, when we look at large transfers of wealth, sometimes they might be direct to somebody, other times they might be in trust. Now, the annual exclusion amount has a special set of rules where typically it can only apply where there's immediate unrestricted benefit to the recipient, which means many transfers in trust don't qualify for the annual exclusion. And again, I want to emphasize this annual exclusion applies before we use the applicable exclusion, which, as you recall, is that bigger $13.99 million. What that means is that gifts that never exceed the annual exclusion are never going to dip into that broader applicable exclusion. So here's a quick illustration. Again, we have our gift and estate taxes, but first we layer in only against gift tax, not against estate tax, because this is only a gift tax annual exclusion, but we back out our annual exclusion determined per recipient of up to $19,000 per recipient, but it's only for gifts where that recipient has immediate and unrestricted access to the gifted property. Then, after we've exhausted that and subtracted that out from the gift amount, we then layer in our applicable exclusion amount, which is applied in, like I said, a special way, as we'll explore in part 2 of this video. Finally, we get to the GST tax exemption. That offsets GST tax only. This exemption is also equal to the basic exclusion amount given to each U.S. citizen or resident, but it's a separate exemption that's only used to offset GST tax. Use to offset GST tax doesn't affect gift or estate taxes or the applicable exclusion amount, or vice versa, although the two are usually applied in tandem. But circling back, this is equal to the basic exclusion amount adjusted for inflation, currently $13.99 million for 2025, but it doesn't include the deceased spousal unused exclusion amount, because that election to preserve unused exclusion only applies to the gift and estate tax basic exclusion and doesn't apply to the GST tax exemption. One unique aspect of this, too, is that because GST tax can apply both during life and after death, this exemption broadly applies to both types of transfers. Whereas with the applicable exclusion, it's applied, as we'll see in the follow-up, as a tax credit, but the application can be a little bit different between gifts versus transfers at death. So with that being said, we have a potential generation skipping transfer tax where we're making transfers during life or at death that intentionally skip living members of the generation below the transferor, but GST exemption can be used through a term called allocation at the time of a transfer that might be subject to GST tax, whether now or in the future. We also have a GST tax annual exclusion, which is really designed to work in parallel with the gift tax annual exclusion to say because certain direct gifts get that $19,000 per recipient annual exclusion, and because GST tax is its own separate independent tax that is applied as an additional layer, then most transfers that qualify for that gift tax annual exclusion will also get a separate GST tax annual exclusion. Now, the tax code doesn't expressly create this or refer to it as its own annual exclusion per se, but instead states that the GST tax isn't going to apply to quote-unquote non-taxable gifts. In other words, those gifts that are arrived at by use of gift tax annual exclusion and thus are not subject to gift tax. Now, it's also important to note that while it usually applies to gifts that also use the gift tax annual exclusion, that won't always be the case. They don't perfectly match up. There's some transfers in trust that might qualify for the gift tax annual exclusion, but those transfers may not qualify for the GST tax annual exclusion. Importantly, too, this also applies before GST tax exemption is used, and as we'll see in the follow-up, it also applies before we look at the amount of the gift and the gift tax annual exclusion and use of applicable exclusion itself as well. So again, like with the gift tax, we have this green layer of GST tax annual exclusion, which we first back out and subtract from the amount of the transfer that's subject to GST tax. And only after we've subtracted out that amount do we then go to the broader GST tax exemption. Finally, we have the direct payments exception that says there's no gift tax during life on direct payments of any amount on behalf of any recipient as long as the payment is of medical or tuition expenses incurred by that recipient. Now, the important point here is that this has to be a direct payment. You don't get this exception if you give the money to the recipient first and then they turn around and use it to pay those expenses. Instead, it has to be you paying those expenses directly to the vendor of medical or educational services directly, specifically limited to tuition on the education side. Now, it's important to note that this is an exception to both gift and GST tax. For gifts, it only applies at the time of the payment, but for GST tax, as we'll explore in the part 2 to this, it can apply to payments from trusts, maybe even after a transferor's death as well. And again, I want to emphasize there's no limit on this amount as long as the requirements are satisfied. And this creates another priority layer that kicks in even before we consider annual exclusions and before the bigger applicable exclusion for gift or estate tax or GST exemption. So as we see here, we can use this direct payment exception mainly for gift tax transfers, but also maybe after death for transfers that might be subject to GST tax. The catch is that for the gift tax exception, it only applies during the payor's life. You can get the GST tax exception both during life and after death. But after you've backed this out, then you look to annual exclusion, then applicable exclusion for all other gifts that aren't direct payments. So, as I mentioned in the article linked below, paid subscribers to my newsletter, State of Estates on Substack, will get an in-depth look at how the applicable exclusion and GST exemption are applied. But again, I emphasize, please only subscribe if you are a wealth transfer professional seeking education and not if you need assistance with your own tax situation. And if you enjoy this and the paid follow-up video, this is also a component of a quick start educational course on the basics of estate planning that I'm creating that can equip both new hires and experienced professionals making a pivot to estate planning to quickly and effectively gain the knowledge needed to step in and hit the ground running from day one. So with that being said, stay tuned for more. And as always, if you have questions on the material itself, you can reach me at griffin@griffinbridgers.com, but I want to emphasize, 1, I can't answer all your questions, and 2, I can't provide tax or legal advice in response to your questions. So if you reach out, don't use it, don't state, I have a fact pattern, how would this apply? It's really just questions on this material itself. But I thank you again for listening, and I look forward to seeing you in my future content.